Hey, party people, Ben from Pivot, and today talking about money news in human words, helping you understand and unpack the key headlines and the things that you need to know to actually make smart money decisions based on what's happening in the world today. The first thing that I wanted to cover was the census data has just been released, and there's a bunch of really interesting wealth statistics in there, a bunch of interesting just social statistics as well. But essentially, a few interesting trends and themes in there. Basically, the millennials have just taken over baby boomers, now tied as the largest part of the population, which is pretty exciting that we can hold it over our parents' generation. But I suppose one of the impacts of that is that when it comes to the tax policy, the rules around this, then it's going to mean that given that the millennials are now a larger cohort and the largest cohort, that we are likely to see some policy shifts towards the issues that are more important to the millennial group, which is obviously a good thing. The weekly median income, really interesting around this, that in New South Wales, the weekly median income, $813 for individuals and $2,185 for families in 21, which have increased significantly from 2016 when the individual income was $664 and $1,780 for families. So a pretty decent jump up there. We also saw 3 million occupied private dwellings across New South Wales, which is an increase of 200,000 from the 2016 numbers. So talking about supply and demand in the property market. From 1971, I was looking back at some of the historical data, there was just 1.4 million occupied private dwellings in New South Wales. So clearly the supply is coming online, but the population obviously is growing along with that as well. Most people are still living in actual houses rather than apartments. This is a 65.6% of the population, which was actually a decrease from 66.4% in 2016. The percentage of people living in apartments has increased from 19.9% to 21.7%. And we can see from this data that 64% of households in New South Wales were homeowners, either property owned outright or with a mortgage. Now, one interesting stat around property in particular is that the change over the last 20 years, we've seen a huge reduction in the amount of people that own their own property outright. And it's no wonder with property values increasing at the rate that they have. But essentially, in 2021, only 31% of people own their own home outright, which compares to 40% of the population in 2001. So 9% down from an initial 40%. It's like 25% less people, which is pretty huge. Also, for those people with a mortgage, 1 in 7 are falling into the common definition of mortgage stress, meaning that repayments account for 30% or more of their household income, which obviously in light of interest rates rising, there'll be even more people feeding into this cohort as well. So there's a ton of interesting stuff in there. The website is actually quite user-friendly and easy to navigate. So if you're a bit of a money nerd like me and keen to learn more, you can jump onto the census data website and check that out as well. But I think interesting to see some of those changes, and the census data essentially drives a lot of the policy actions from government. So hopefully we can see some of those things to address housing affordability, debt levels around the country as well. The next piece that I wanted to cover was around the unpaid tax gaps that exist in Australia. And I put this one together, actually was doing some content and basically got slammed or not me personally, but a lot of the people jumped on and were commenting about how the ATO should be pursuing the big, evil multinational corporations and getting their tax slice that way instead of pursuing individuals. So it got me thinking, and I started doing some research into, unpaid tax and what those tax gaps might be. And essentially, the ATO each year calculate what they call an unpaid tax gap. But they look at what the tax would be collected if everyone was to pay, follow the rules and be 100% compliant with the tax law versus not. So in the most recent stats, which are actually from 2019, basically the ATO have calculated that they receive 92.7% of all tax revenue that they were owed. So essentially what that means is that there's about 7% of tax which is not getting paid, and then it actually breaks it down into the different groups, so you can see who is like falling into this unpaid tax group. Now what I should say is that the ATO call out when they're doing this that it can the unpaid tax can be for a number of reasons. Can be because of a general sort of error or people not knowing, but it can also be if people are purposely, sort of bending the rules to their advantage. So for individuals, the unpaid tax gap was 5.6%, or a total of $8.4 billion that the ATO have calculated as unpaid tax for individuals. That was second only to small business group, which is $12.5 billion, or a 12.7% unpaid tax gap. For medium business, the tax gap is $814 million. High net wealth individuals at $760 million. And for large corporates, it's 8.3%, or $5.1 billion. So you can see that the individuals and small business groups are the biggest when it comes to how much tax dollars are not being collected by the ATO. And that is why the ATO target individuals and small businesses in particular when it comes to their tax collection, because there's essentially $20 billion in unpaid tax, which is about 3/4 of the total unpaid tax in Australia. So look, I get that, it's annoying that the ATO is looking at individuals more closely than, what we might see as the bigger corporates that can afford to pay more tax. But there is a reason and a method in their madness. I found some stats last week as well around, like I was reading about the recession and whether we're headed that way. Obviously, there's a lot of talk and headlines around, is Australia going into recession or is it not? And I found that there's one particular statistic that might actually save us when it comes to our the potential for us to fall into recession. It's not actually the fact that our wealth has increased massively by $3.6 trillion since 2019, or the fact that the household savings rate has more than doubled to 11.4% over the last little bit. But it's the fact that our unemployment in Australia is currently at a record low 3.9%, basically a 50-year low, with more women and youth in particular picking up full-time jobs. So I was looking and diving deeper into some of the stats and the numbers. And essentially what's happened is that households through COVID have massively been saving massively more. They've massively increased the amount that they're saving. And they've now got these bigger war chests behind them. I get that, this doesn't apply to every household, but across the population generally, households are sitting on a lot more cash. Now, what is expected to happen is that as the economy slows down, and the economy is slowing down now and will continue to slow down over the shorter term, is that households are expected to live off some of those savings until the economic conditions improve. Because as inflation is at a high rate and wage growth is not keeping up with inflation, it means that there's a gap between people's disposable income. Their real incomes are going down. But because people are sitting on cash, it means that they can continue to spend as they go through the pandemic. And with jobs and this unemployment rate at an ultra low level, we're seeing like 7 job vacancies for every 10 unemployed people, which is up from 3 job vacancies for every 10 unemployed people before the pandemic. So what that all suggests is that if people are staying in jobs, even if there might be a technical recession or slowdown in economic growth, it's not a technical recession. If people have still got jobs and because we are buffered a little bit with this savings rate, it means that we can potentially ride out this storm so as to not be as affected from an economic perspective, which I think is really positive news. And I'm hearing a lot of people at the moment talking about, share market is tanking, property market's tanking. Everyone's saying that it's the world is about to end. But the fact that we do have really strong fundamentals in a lot of different areas of the economy suggests that we could fare much better, and gives us all of the fuel that we need, I think, to surprise some of the expectations or some of the negative expectations and for things to continue in a more positive way than what a lot of people are talking about. So yeah, definitely some positive news there. On the flip side of that, I wanted to talk a little bit about the tech market meltdown, and I was looking at some of the statistics in the US bear market with the NASDAQ is now down like 35% since the start of the year. What I found is that the NASDAQ is a technology-based index of around 4,800 companies that is predominantly technology-based in the US. Now, of those 4,800 companies that make up the NASDAQ index, 40% of those stocks are down 50% or more, and 20%, so 1 in 5 of the stocks are down 80% or more. And anecdotally, I'm talking to a lot of people at the moment as well that work in tech and have just seen the value of their tech shares destroyed over the last little bit. And look, to me, this really highlights the importance of diversification. I get that for the last like 15 years, I've seen huge run-ups in the tech market, and people think that there's no better place to be investing their money. But the disruption that we're seeing at the moment goes to show that having a diversified approach to your investments means that your ride is going to be a lot smoother than just being exposed to one sector. So what we've been seeing perform really well over the last little bit is the resources sector. So we've seen huge growth in that space over the last little bit with commodities, currency, and resources working in their favor. And it's likely over the shorter term that will continue. I get that it's really hard to diversify away from an asset or an investment class that you think is performing really well, or that is performing really well. But knowing where the risks are in your strategy and having appropriate risk management in place is just going to mean that you have a much less stressful ride. And I think while there's a lot of people that have been caught short, and I know definitely, my portfolio has been impacted from the tech disruption, there's a lesson to be learnt there in that as market conditions recover, just because something is performing well, it doesn't mean that it will continue to do that forever. Tying in with the tech meltdown is the impact on the startup community over the last little while with the disruption that we've been seeing to markets. And a lot of startups are in the technology space at the moment. These companies are currently facing huge challenges when it comes to their funding. And we're seeing a whole heap of companies that are cutting jobs and expenses over the last little bit. Companies like Milk Run, Competitive Volley, Vault Bank just closed down last week, which is really sad news for one of the first neobanks in this space. We've also seen Zepto, Mark 43, just to name a few of these companies that are paring back on expenses, cutting jobs. And I think that companies that haven't raised money or that were due to raise money in the current climate are really struggling to get that funding with the valuations massively declining. And we're seeing a bit of a two-tiered market in that we're seeing a lot of companies that have done big raises in the recent past that are now cashed up, can manage their expenses over the next little bit. And I think that they'll perform better. But the companies that are needing to raise are really having to look at their bottom line and pull back on costs, which means that they'll they're potentially going to struggle over the last little bit. Interestingly, that in interviews and surveys with a lot of the founder groups or the leadership groups of these companies, the statistics showed that most of them thought that they would be the exception to the rule and essentially be able to just grow their way out of the crises, which is obviously positive thinking, but it's something that if you look at the law of averages, it just cannot apply. So I think the sector's in for a challenging time, and I think any investors should be choosing really carefully with where they're putting their money. I think startups are always a high risk, high potential reward investment. But I think in the current, over the next little while and in the current climate, in particular, these investments are going to really struggle. Now, the next piece that I was reading something interesting in how to sell your property on for $125,000 premium above your neighbor, essentially, and it basically found that there were some groups of properties that were selling for this on average for houses $125,000 more, $72,000 for apartments, and it was all down around being energy efficient. The houses with solar panels, rainwater tanks, and insulation got 8.7% more views online and sell 4% faster than other properties that don't. So in Queensland, Victoria, New South Wales, the energy efficient homes commanded a premium of 28%, 24%, and 16% respectively. So Queensland being the biggest, and massive, like 30% almost more premium for energy efficient homes versus not. Probably a little bit of bias in there with the fact that the homes that are more energy efficient tend to be newer, which would mean that they are selling for a premium regardless. But it shows that there definitely is a premium attached to these more energy efficient properties. So for property sellers in the current tough market conditions, could be a point of differentiation, help you sell your home for more or sell it faster. So for anyone, that might be on the cards for them. Think about how you could, boost your energy efficiency and get a few more bucks for your property in the process. My final piece for this week is around the doubling of Australian spend on buy now, pay later services to a massive $11.9 billion a year. Essentially, through 2021 financial year, Australians spent almost $12 billion through buy now, pay later, compared to just $5.6 billion 3 years earlier. So basically 100% more, over 100% increase. The buy now, pay later platforms have now reported 5.9 million active accounts in Australia, which, when you consider that our total population for all age groups, including under 18s and seniors as well, is 25 million. That's a huge amount of penetration. The government has really struggled with regulation around this industry, and I think it's something that needs to be focused on for the next little bit. The Finance Industry Association reports that 18% of buy now, pay laters have missed at least one payment on their purchases. So there's a little bit of risk there. And I think some serious risk to the sector. I know when Afterpay was kicking off massively, that that was something that had a massive impact on their share price volatility over time. When the regulators said that they were looking into this, prices started getting wobbly. When that sort of subsided and the price kept kicking off. But it seems like a fair bit of economic risk, particularly as the banks start moving into this space as well. Clearly, there's a lot of money to be made, but I think it comes with a bit of risk. So something to be careful of. I've spoken before about buy now, pay later services and on a personal level, how that can lead you into the trap of chasing your tail. I get that leveraging someone else's money is something that can make seem like it makes a lot of sense, but if you're doing it because you need to, as opposed to because you're trying to be smart, then you're probably going to struggle to do any of the other money goals that you've got. And chasing your tail with savings is not a fun game, so one to look out for. Guys, that's it for me for this week. I hope you enjoyed that. I'll catch